Have you noticed the quiet? The market has been remarkably calm lately, almost eerily so, actually. It's the kind of, well, serenity that makes you wonder, is this the new normal? Or is it just, the quiet before something significant happens? Today, we're taking a deep dive into your sources to explore exactly that. We're zeroing in on two pretty powerful market indicators. First up, the CBOE Volatility Index. You know it, the VIX, the market's fear gauge, as everyone calls it. But then we'll turn our attention to its, well, less talked about cousin. But it's incredibly revealing. The VVA VIX ratio, that measures the volatility of volatility itself. Sounds complicated, but we'll break it down. You've given us some really fascinating research, some great charts here. And our mission in this deep dive is, well, to cut through all the noise. We want to extract the most important insights and give you a clear understanding of what these signals might imply, both for short-term market stability and potential shifts in the medium term, too. We're really looking for those surprising facts, those practical insights that can help you navigate what's going on.
And right now, yeah, the surface appears placid, very calm. As of early September 2025, the VIX is definitely subdued. It's hovering near some historically low levels. And that VV-GIX ratio, it's sitting comfortably in a neutral zone, suggests a calm risk environment. But, and this is the key thing we'll unpack today, neutral doesn't always mean uneventful, right? These indicators, they're constantly whispering clues if you know how to listen.
Wait, so let's start with the VIX then. We all hear fear gauge, this real-time pulse of market anxiety. But beyond the headlines, what specific story has it really been telling us lately? With its recent movements, what patterns are jumping out from the data you've shared with us?
Well, the VIX, at its core, it measures the implied volatility of S&P 500 options. So essentially the market's forecast for how much the S&P 500 might swing over the next 30 days, that is. And the story it's been telling lately, it's one of steadily diminishing expectations for big moves, like really dialing back those expectations. We've seen a very clear downward slope on the daily chart, lower highs followed by lower lows. Think of it like a drum beat, just getting softer and softer. So take early April 2025, for instance. Remember that. The VIX spiked dramatically, got up to around 60 amid some global concerns. But since then, subsequent bursts of volatility, they've been strikingly muted, really quite tame. During that geopolitical flare-up in June, it only reached about 22, and then it quickly retreated below 20 again. Then, just in late August, it barely managed to touch 17 or 18. So each attempt it makes to rally, it's weaker than the last one. And that's leading to this noticeable compression in its trading range. It's getting squeezed.
Right, so it's not just a general downtrend, but there's a specific shape forming here. Our sources really highlight a particular technical pattern that kind of brings home the underlying sentiment. What can you tell us about that? And what's the surprising implication? Because there usually is one, isn't there?
That's exactly right. If you visualize those declining peaks, the highs getting lower, and then you look at the relatively consistent lows, you see what technicians call a descending triangle or wedge. It's a classic pattern. The VIX has repeatedly found support around that 14 to 15 level, like a floor just can't seem to break through sustainably. I mean, the year-to-date low for 2025 was 14.58. It dipped briefly to 12.70 late last year, late 2024. But each time it bounces off that floor, the high it reaches is lower than the last ones, like like a spring being compressed tighter and tighter. And that reflects a market that's becoming increasingly complacent, just getting really comfortable with the calm. And here's where it gets really interesting, I think. Given the VIX's inherent nature, it's mean reverting, right? It always tends to cycle back towards its long-term average, eventually. So such a falling wedge in volatility often foreshadows an upside break. That's the typical resolution. This isn't just a random pattern, it's like a coiling spring. You said it perfectly. The longer this compression lasts, the more pressure builds up for a sudden expansion, a pop in volatility.
Because there's a fundamental limit to how low the fear index can actually go. It can't go to zero. So this quiet period is likely creating the conditions for a future spike. It's a key insight, really. The calm itself can be a precursor to potential turbulence down the road.
That analogy of a coiling spring really does bring it to life. Makes sense. So if the VIX is indeed range-bound, can't go below zero, usually moves within certain bounds outside of major crises, then identifying those critical tripwires, those sort of pressure release valves, that becomes essential for you, our listener, to understand. Where are those key support and resistance levels on the VIX chart right now? What should you be watching?
Exactly. Let's map those out, those crucial boundaries. On the downside, that 13 to 15 zone has proven to be incredibly robust support, really strong. Like I said, we've seen bounces from these levels repeatedly. This mid-teen zone, it's generally considered the lower bound of normal for market volatility, sort of the baseline calm. Now, if the VIX were to break and sustain below 14, that would signal truly extreme complacency, almost irrational levels of calm. And here's the critical part, the asymmetry. The VIX's long-term average is around 19. Its all-time lows are way down near 9. So sitting there in the mid-teens, the VIX just doesn't have that much room to fall further. The downside seems limited, but it's upside, as we've seen in history. It can be explosive if some kind of shock occurs. This asymmetry, limited downside, potentially immense upside, that's absolutely central to understanding where we are right now. Okay, moving to the upside then. Resistance levels. The first significant one, sort of the threshold between complacency and fear, sits around 20 to 21. That's a key line in the sand. Our sources highlight how the VIX consistently failed to hold above 20 even during those little volatility events in 2025. It just snapped right back below. So a decisive break and hold above that 2021 level. That would signal a clear shift in market sentiment, a change in the air. Beyond that, the 25 to 30 zone, that's where we start seeing more persistent market anxiety, things getting genuinely nervous. And anything above 30, well, that represents a significant regime change. You're entering panic territory then. That usually comes with a major market correction. Just remember how the VIX soared past 82 during the COVID crash back in 2020. Volatility doesn't just creep up slowly sometimes. It can accelerate. It can explode higher really rapidly once it breaks out of these normal ranges.
Okay, so we've dissected the VIX's price action. We've charted its critical levels. That's super helpful. But what about the underlying currents, beneath the surface? Beyond just the direct price, what do the momentum indicators tell us? Things like RSI and MACD. Are there any sort of hidden clues you're picking up there for our listener? Anything subtle to watch for?
Absolutely, yeah. The momentum indicators offer a deeper perspective. They can give early warnings sometimes. So the Relative Strength Index, the RSI, it gauges the speed and change of price moves. It slid down towards the lower 30s back in late August. Now for the VIX, this suggests maybe over-complacency rather than being truly oversold like it would for a stock, but it has since recovered. It's back into the 40 to 50 range in early September, which indicates that while downward momentum is still generally present, it's weakening. It's losing some steam. And here's something particularly insightful, I think. The RSI actually made a higher low in August, even as the VIX itself made a marginal new low in price. That's a classic bullish momentum divergence. A positive divergence for volatility, which means negative for stocks usually. It's subtle, sure, but it's a potentially powerful clue. It suggests that the VIX's downward pressure is losing steam, that it's running out of room to fall further. And maybe, just maybe, an upward reversal could be on the horizon. Then there's the MCD, the Moving Average Convergence Divergence Indicator. That tracks trends.
It has been below zero, which is consistent with the VIX cooling off, trending down. However, right now, it appears to be bottoming out. That's what the chart suggests. And it looks like it could be on the verge of a bullish crossover. If VIX prices start to firm up a bit more across above its signal line, well, that would be an early sign that upward momentum and volatility is returning. So it's a quiet indicator right now, but crucial to monitor for that potential shift.
Okay, so we have these subtle hints from momentum. Interesting. What about the actual trading activity, in related markets like VIX options and just the broader health of the stock market itself? Do they sort of confirm this story or they challenge it?
Good question, because you need to see if the different pieces fit together. Right now, looking at VIX derivatives, the options and futures, we're not seeing any extraordinary surge in volume or open interest. Nothing that screams traders are aggressively betting on a big volatility spike right now, which aligns with the current surface calm. However, and this is an important contrast, if we think back to 2023, the picture was quite different. VIX options volume surged back then, even as the VIX itself was actively sinking. What was happening? Well, big players loaded up on upside calls. They were buying protection, essentially tail hedges, that heavy hedging under the hood during calm markets. That was actually a significant red flag pointing to underlying complacency, believe it or not. People were nervous despite the calm. So a sudden spike in VIX call buying now, especially if the VIX stays low, that would be a strong signal. It would suggest that smart money is quietly getting nervous again, bracing for turbulence. It's a critical early warning to watch for. And then there's market breadth. You mentioned the broader market. Market breadth is just about how many stocks are actually participating in an index's rally, right? Is it broad-based or just a few big names? Generally, broad stock market participation, lots of sectors doing well, that keeps volatility subdued. Helps keep the VIX down. In late August 2025, as the S&P 500 was hovering near its highs, breadth was reportedly excelling. That definitely helps suppress the VIX.
Okay.
But narrowing breadth, where fewer and fewer large-cap stocks are doing the heavy lifting, propping up the indexes, that's often seen as a harbinger of impending volatility. It signals growing fragility beneath an otherwise calm surface. It's like, watching cracks appear in the foundation. Even while the paint on the wall still looks fresh, something's weakening underneath.
This really does feel like we're pulling back layers here, getting beyond just the VIX number itself. Now let's pivot. Let's talk about the VVX-VIX ratio. This isn't just about how nervous the market is right now. It's about how nervous traders are, about how nervous the market might become in the future. How does this fear of fear itself ratio, as you called it, offer a unique lens on market sentiment? What does it add?
Yeah, it's a great way to put it. Fear of fear itself. Let's just clarify again. VVIX, that's the volatility of volatility index. It measures the implied volatility of VIX options themselves. So the VVIX ratio compares this volatility to the current level of volatility. Think of it like this. VIX tells us how nervous the market is right now. But the VVIX ratio, it tells us how expensive protection against future VIX spikes is relative to the current VIX level. Are people paying up for that future protection? Technicians watch this ratio very closely for extremes because it often flags crucial turning points in market stability, sometimes before the VIX itself moves dramatically. And here's where we can find some really fascinating historical insights. It gives great context. Very low values for the ratio, say down around 2 to 3. They typically occur during full-blown market panics, when the VIX is already extremely high. So, for example, during the March 2020 crash, the ratio dipped near 2.5. What did that indicate? Well, unprecedented fear, obviously. But it was a uniform fear. Everybody was already panicking.
So the demand for additional volatility protection didn't spike as much proportionally compared to how high the VIX already was. Fear was widespread. Now, on the flip side, very high values for the ratio, like 8 to 10. These are often a classic signal of extreme complacency, the calm before the storm sometimes. The prime example, late 2017, that was remarkable. The VIX had sunk to a record low, around 9, unbelievably calm. But the VVIX was still hovering way up around 90, which pushed the ratio, VVIX divided by VIX, up to about 10, extremely high. What did that mean? It meant the market was eerily calm on the surface, yet options traders were quietly pricing in the possibility of volatility returning. They were paying up for VIX calls. Our sources describe it perfectly as a powder keg under the pillow. And sure enough, what happened next? That preceded early 2018 when volatility famously exploded higher, the Volmageddon event. So that high ratio was a clear warning sign. Quiet demand for future volatility protection was building up under the surface. Okay, so fast forward to now, early September 2025. Where are we? The ratio is roughly in the mid 5 to 6 range, maybe 5.5, 6, somewhere around there, which is right around its long-term median, which is about 6. So this suggests a pretty normal risk environment. It's not flashing any major warning signal right now. Not extreme complacency, not extreme panic. The market seems calm, but not utterly complacent. There's some underlying hedging activity, sure, but not at those extreme levels we saw back in 2017. It's balanced. So naturally, this raises an important question for you, the listener. What shifts in this ratio would be crucial to monitor going forward? What would be a red flag? Well, a rising ratio towards 7 or higher, especially if it happens without a corresponding big jump in the VIX itself. That would be a significant caution flag. Pay attention to that. It would imply that vols is outpacing the VIX, suggesting underlying uncertainty about future volatility despite a calm surface. People are getting nervous about the future, even if today is calm. It's like a canary in the coal mine. It means traders might be aggressively buying VIX options hedges, even though the VIX itself is quiet. That would signal a stealth buildup of protection, a warning sign. Conversely, what about a falling ratio? A falling ratio toward 5 or below. That would most likely accompany a surge in the VIX. They'd probably move together in that scenario. This suggests that high current volatility is expected to continue. Turbulent times are here and expected to stay. This is common during a broad market sell-off when the market is broadly fearful. Everyone's already scared. Sometimes such low ratio extremes can even mark capitulation points. When fear is fully realized, fully priced in, and maybe close to exhaustion. We're not there now, obviously. But it's a key signal to understand if a correction does unfold.
This is an incredibly insightful framework. Really helps to read the market's deeper psychology, not just the headline VIX number. So, bringing all these signals together now: VIX patterns, momentum, options activity, breadth, the VVIX ratio. What's the verdict for the near future, say the coming weeks? And then what should we realistically expect in the medium term, maybe over the next 1 to 3 months? What does this all mean for our listeners' outlook? How should you be thinking about this?
Okay, let's try and synthesize this. For the near term, meaning the coming weeks, the technical picture seems to point towards a continued, cautiously low volatility environment. Keyword, cautiously. The VIX is likely to, well, oscillate in the mid-teens to high-teens range, bounce around in there, as long as it remains capped under that, say, 18 to 20 resistance level we talked about. Now, you should anticipate swift but brief VIX pops on minor news. Those quick little spikes, those whipsaws that don't really sustain, they fade quickly. VIX consistently in the teens. It means the market is not in panic, but it's not entirely comfortable either. There's still a healthy awareness of risk, just not immediate fear. So key near-term signposts for you to watch. Definitely that 14 to 15 support floor on the VIX. Does it hold? Does the VIX start to curl upwards from there? That would be significant. Also keep a close eye on the VVIX and its ratio. Does VVIX and therefore the VVIX ratio start rising even as the VIX stays relatively low? That signals that stealth protection demand building. And crucially, monitor any deterioration in equity market breadth. Are fewer stocks carrying the load?
That's a warning sign. Okay, now shifting focus to the medium-term outlook. Say the next 1 to 3 months. Here, the outlook grows significantly more cautious. I think that's fair to say based on the signals. Conditions seem to be becoming ripe for a volatility reversion higher. Things are lining up for to potentially move up. The VIX is just unlikely to remain in a downward slope forever. It's cyclical. Volatility is cyclical. Always has been. This isn't just a prediction, it's really an observation of market history and these current technical setups. And the reasons for expecting this potential medium-term shift, they're pretty clear from our analysis. First, that descending triangle or wedge pattern we discussed, it suggests an eventual resolution is coming. And given the VIX's limited downside near these historic lows, that resolution is more likely to be volatility expansion, a break higher. Second, the support in the mid-teens has proven remarkably resilient. It keeps holding. That suggests buying interest comes in down there. Third, those momentum divergences we highlighted earlier. They hint that the selling pressure on volatility is easing up.
And finally, the current sort of Goldilocks scenario market positioning. It has created widespread complacency, which, remember, makes the VIX's downside limited, while its upside remains explosive if some catalyst emerges. This configuration means the market could be uniquely vulnerable to a volatility shock if something unexpected happens. So the implication here is that the VIX could trend back towards its long-term mean, around 1920 or even higher. Now, this wouldn't necessarily signal a crisis or a crash, let's be clear. It could just be a normalization to more typical volatility levels, getting back to average. That 20 level we keep mentioning, it's like a magnet and a pivot. It draws price towards it, and what happens there is key. If the VIX pushes through 20 decisively and holds above it, that could signal a volatility regime change, a shift to a potentially choppier market. And the V-VIX ratio will be your critical confirmation tool here. If VIX lists towards 20, but the V-VIX ratio remains contained, stays in that mid-range 5-6 area that suggests orderly hedging, manageable concern. If VIX rises and V-VIX rises even faster, sending that ratio climbing towards 7 or higher, that would indicate growing unease and potential for an overshoot in volatility. Much more concerning.
Wow, what an absolutely incredible deep dive into the sort of hidden mechanics of market sentiment, really peeling back the onion layers there. We've seen that while the surface of the market might project this image of calm, maybe even complacency, there are multiple layers of signals from price patterns, momentum, options activity, even that fear of fear itself hinting at significant potential shifts ahead.
Yeah, exactly. If we connect all these threads, try to see the bigger picture. The technical evidence really points to a market enjoying the current calm, yes, but it also shows multiple signs of late-cycle complacency that typically precede a volatility uptick. That's the historical pattern. The VIX downtrend looks like it's flattening out. That crucial support level is holding strong, and those subtle momentum shifts are emerging. They're faint, but they're there. And the VV-VIX ratio, while it's neutral right now, gives us that essential framework. It helps us recognize when underlying anxiety might be building, even if the surface still looks quiet.
So for you, our discerning listener listening in, the clear takeaway from this deep dive seems to be this.
Enjoy the low volatility while it lasts. It might persist for a bit longer, but don't be lulled into a false sense of security by it. The charts, history, they consistently remind us that periods of low volatility often sow the seeds for the next spike. Calm breeds complacency, which makes the market vulnerable. So keep a close watch on those key VIX levels. We mapped out that 15 support floor and that critical 20 resistance pivot level. And remember what a sustained breakout above that 20 level could signal for your portfolio and risk management.
You know, there's that old adage in technical circles, right? The time to fix the roof is when the sun is shining. Well, with the sun currently shining pretty brightly on the markets and the VIX barely casting a shadow, now is probably the moment to prepare, to think about your plan for when those inevitable clouds gather, because they always do eventually. The volatility charts are calm right now, maybe just before a potential storm. What will you be watching for?